Hey, welcome to this video. Thanks for joining me. Now, my goal in this video is just to share my opinion about what is going on in the market. Now, we all know that the stock market made a very quick recovery, and we knew that something wasn't right, especially with the unemployment rate still being at the levels it is right now and the virus still being a problem. We still don't have a solution to the problem itself. So the recovery was not reflecting the reality of things. Now, based on the outcome of the meetings of the Feds yesterday, we saw that they are planning to hold the rates near zero up until maybe 2021 to 2022. With that news, the ideal thing in a situation like that would be that the stock market should perform well because the companies can still hold on to their debts and borrow money at very low interest, which would help to fund their activities. However, the stock market actually went to the decline. Now, as we speak this morning, the futures market is actually down about 500 points. And that's not good. Now, if you remember my last video that I talked about the reality of things, the stock market was in a V-shaped recovery, which was one of the anticipated moves of the market. But right now, it's looking like a W because if today ends up in a red, as the futures are indicating, then that will probably initiate the W shape. And in fact, I'm thinking the market will drop a lot more because the underlying factors are still there. Unfortunately, they are currently seeing increase in the virus in different counties in the United States, and also some states are reporting an increase in numbers of hospitalizations of people with this virus. So point is this: if this continues the way it is, and as we approach fall, this will also probably continue further, especially during the fall season, knowing that the virus tends to perform or spread more rapidly during that period, then there's a chance that the economy will stay in recession for a while. Although they're trying to open up the economy and try to, support the economy by funds and money pretty much by the Feds, that is obviously good. It's only going to support the stock market, but it doesn't really change the reality of people. And you have to remember that people are the ones that make up the economy. If people are getting sick, people are unemployed, and people are not spending money, no matter what they do to the stock market, it won't reflect, because what happens is that the stock market might hold steady, but the economy will still keep going into a decline. How low will this keep going, or how far is it going to keep going? Obviously, we do not know, because if there is no vaccine that is ready to be deployed and hope to cure people, or at least prevent people from getting this virus, then the economy will remain very unstable. Now, there are some sectors that will benefit from a situation like this, just like we've seen in the past. Think about Zoom. Zoom took off during this period. Now, if this continues for a while, then sectors like that, or the technology sector in general, may keep performing. But there's something that is still underlying with those people, because at the end of the day, people are still not spending like they used to. So in my opinion, I believe that the performance that these sectors are having doesn't really reflect what is going on. The other sector that I feel for at this moment is the finance sector, because you have to remember that if people have jobs, they're able to get paid, they make a lot of money, they can put it into the banks, and the banks can lend out this money at higher rates. However, the interest rates are very low right now, which means that they cannot really make a lot of money through that method. Obviously, the Feds buying these treasury bonds and stimulating the economy through their loan programs will help. But at the end of the day, they are not going to make as much money as they used to when the economy was performing well. And that has already been reflected in the stock market prices. If you look at some of these banks, you can see their stocks are much lower than other sectors. The question is this: so what should we do, or how do we go forward from here? The point is, you have to invest based on your own understanding and based on your own knowledge. And most importantly, invest based on your own risk tolerance. I've always been saying, if you check out my videos, that this might be a situation or a time for you to rebalance your portfolio so that you are well diversified in your investments, because the stock market will remain quite volatile for the next couple of months, in my opinion. Obviously, overall, it may still perform, but I don't think the performance is supported in any way. But as we all know, we know that if the stock market is down, it presents an opportunity to buy. So if you want to keep holding more stocks, well, this may be the opportunity to set up your trades in such a way that you can take advantage of some of these declines. But you got to remember, it might be a long way to recovery and things may not happen as quick as we're thinking. But hopefully, there is a vaccine soon, and this will help to curb the downside of the market. The truth is, no matter what the Feds do, the stock market will still react based on emotion. That's what it's always done. Fear, panic, and the bad news. You need to think like an intelligent investor and invest based on your understanding and based on what you see opportunities in. I hope you found some value in this video, and I hope that you've learned something from this video. Please give this video a thumbs up, and if you haven't checked out my channel, check it out and subscribe to the channel.